The Chinese market is a total mess. The Shanghai Composite Index lost 30% of its value over a 3-week period starting in mid-June. Then, after a modest rebound, it plummeted again this week, losing on Monday, the 27th of July, the biggest single loss in a decade. The volatility has caused some considerable concern in other economies over fears that China's woes will spur a global sell-off. However, this is not likely to happen. The Chinese stock market is notably very different from other trading floors. It is highly speculative, and bets placed by the retail investor who lives there are unlikely to reflect broader economic and corporate trends, particularly when compared to the institutional investors who dominate exchanges in other major economies. Moreover, companies have relatively little exposure to market fluctuations in China. Only about 5% of private sector funding in China comes from the stock market itself. This gives businesses a layer of insulation from market volatility. In other words, the Chinese stock market does not reflect the country's economic health in the same way that markets do in other countries. If exchanges in New York, London, or Tokyo were to suffer a 30% decline, fears of a depression might be warranted. But in China, such volatility does not necessarily mean they're in an economic crisis. Now, there is no denying that the Chinese economy is slowing, and that the broader trend is certainly troubling. But the stock market's fluctuations are a very, very minor factor of the country's economy and offer no real insight into China's economic direction. The greatest concern over Chinese markets is not that it will create an economic crisis, but that it will create a political crisis for Chinese leaders. For most of the last 2 years, party leaders in China have encouraged investment into the stock market, in part to steer Chinese investors away from real estate, where fears of a bubble also exist. Chinese citizens have been inundated with social media campaigns and billboards touting the safety of the stock market and emphasizing its growth as a key element of the country's modernization. So when the very market that they've been promoting drops amazingly over this short period of time, there's a potential credibility problem for the leadership. Now, it's estimated that only 7% of China's urban population actually owns stocks. So this loss of credibility seems unlikely to be the kind of crisis that will bring demonstrators into the street. The timing of the market's current slide is particularly poor. Party leaders are already at hand drafting the country's next 5-year plan, which, based on the current leadership's track record, is likely to contain some pretty important reforms that could boost stability in China. But a loss of face over a volatile stock market could cost the leadership the opportunity to make these changes, allowing more fundamental economic problems to continue. It is a typical Chinese puzzle. The temptation is to look at daily movements of the Chinese stock market as having immediate impact. Rather, we should be looking at 3 to 5 year time horizons for how China's sliding stocks will impact the Chinese leadership's ability to execute fundamental reforms that will eventually stabilize the stock market. This is Pedro Robert, the founder of the Wealth Insider Network, talking to you from Hong Kong. Thank you.